Exercise 12.5 asks us to look at some common risk ratios. And whenever I'm doing ratios, and I've done them all 1,000 times, if not 100,000 times, I just make sure I know what numbers I'm looking at. The receivables turnover ratio is sales or revenue, an income statement number, and that's divided by the average AR. Just to make sure that I know what I'm talking about. The average collection period is 365 days divided by the accounts receivable turnover ratio. The inventory turnover ratio is the cost of goods sold, another income statement number, divided by average inventory, beginning plus end, divide by 2. The average days in inventory, again, we're going to take 365. That tends to be the common number of days in a year. And divide by the average turnover ratio. Or I guess they just call it the turnover ratio for inventory. Current ratio is current assets divided by current liability. And debt is our total debt divided by our total equity. Just to make sure we understand what we're looking at. So let's go grab these numbers. Our sales is 19,310,000. And our beginning accounts receivable was 1,100,000. Our ending accounts receivable was 1,600,000. Divide that by 2. And we end up with 19,310,000, that number. This number works out to be 2,700,000 divided by 2, or 1,350,000. And when you divide that out, it comes out to 14.3. And that would be 14.3 times. In other words, this company collects its bills, all of its bills, and replaces them with new bills 14.3 times a year. Related to that is how long does that take? What is the average collection period? Take 365 days, divide that by 14.3, you come up with 25.5 days. In other words, from the time we send a company a bill until the time we get their check back, it is, on average, about 25.5 days. The inventory turnover ratio is very similar to the receivables turnover ratio, except we use the cost of goods sold, and we're given the cost of goods sold of 12 million. Cost of goods sold is 12 million. $250,000. And our beginning inventory is 1,500,000. Our ending inventory is 2 million. We add those together, divide by 2, and our average inventory. So we take our 12,250,000. I cheated us out of a zero there. Divide that, 35 divided by 2, 17.5. So that's 1,750,000. And that's 7, and again that's times. So like receivables, where we're talking about collecting money, here we're talking about selling all our inventory and replacing it with new inventory, and we come up with 7 times. The related question to that is, how long does it take us to sell a piece of inventory? Take 365, the number of days in a common year, divide by 7, and it takes about 52.1 days. So our inventory sits on our shelves from the minute it comes in until the minute we sell it, about 52.1 days. That's the average. Okay, now keep in mind, average is just that. It's an average. Remember the old story about the fellow who slept with his head in the refrigerator and his feet in the oven, and on average he was comfortable, but in reality he was pretty damned uncomfortable? Keep that in mind when you're looking at averages. Okay, the current ratio is the current assets, which is cash, accounts receivable, and inventory. And in this problem, you add up those three, cash, accounts receivable, and inventory. You come up with 4,300,000. And we're going to divide that by the current liabilities, and that's the first line in the equity and liability and equity section of the balance sheet. 1,920,000, and our ratio is 2.2 to 1. And the way to interpret that is basically, for every dollar that comes in the door in bills, we have about $2.2 of current assets to pay that bill. And the last risk ratio they want you to look at is debt to equity. And here, this is just a matter of taking numbers off of the balance sheet. The debt part is the current liabilities and the long-term liabilities. So in this case, that's 4,320,000. And we divide that by the equity, which in this case is the common stock and retained earnings. And that's that's 2,980,000 for retained earnings, 19 for common stock, for a total of 4,880,000. And that gives us a percentage, 88.5%. And that gives us the relationship between our debt and our equity. It says roughly, of all our assets, this is how we finance them between debt and equity. That's the way that works out.